Good morning, everyone. Thank you for joining our webinar this morning on ESOP Fables, which will be led by our Employer Solutions team. The webinar will run for about 35 minutes, and after the webinar, the team will have some time for Q&A at the end. So if you have any questions, please feel free to submit them using the Q&A button at the bottom, and we'll go through them at the end of the webinar. We'll also have a few polls throughout the webinar, so please keep an eye out for those. I will hand over to Ruiyuan and Adrian to get us started.
Thanks, Casey. So today's presentation webinar is about ESOP Fables. And I guess the reason why we're calling ESOP Fables is ESOPs, employee share option plans, and equity plans in general are often misunderstood by our clients and employees as well. So for example, I had someone call me yesterday and say, you know, I've got an option plan, how is it taxed? It later transpired he doesn't have an option plan, he actually has a restricted share. Just as an example. So the objective of this webinar is really to hopefully clear up some of these ESOP fables that we come across, provide an overview of how IRS classifies equities and how they're taxed. But ultimately, at the outset, I just want to make it clear that, you know, it's all in the detail of the plan. I would still recommend that a plan is reviewed to get the actual tax implications, but hopefully this will give you an overview of what is likely to be the answer. So to start off with, and by way of introduction, my name is Adrian Sham. I'm a director in the Employer Solutions team. I started my career in Grant Thornton, UK in London, where I spent 10 years doing global mobility and US tax. And then I came over here 5 years ago as an expat and have now localized. I lead the Employer Solutions team, which covers equity schemes as one of those. And my co-presenter is Ruiyuan.
So good morning, everyone. My name is Ruiyuan. So I'm a tax manager in Adrian team. So I've always been an employment tax, expatriate tax advisor for the past 12 years. So I joined Grant Thornton 2 years ago to help support the growth in the Employer Solutions team. Okay, so before we start, we thought it'd be useful to introduce, what is Employer Solutions and what we do in the Employer Solutions team. So broadly, we provide services in the 4 areas: global mobility services, employment taxes, payroll services, and also what we'll be focusing on today, equity rewards. So in equity rewards, what we do is, as you can see, okay, there's a few areas we provide advisory. We provide advisory where we will review equity plans and advise the right steps to ensure compliance. For compliance bit, we provide support to companies whereby they do not have enough resources in-house to ensure compliance. And lastly, we also help out with implementation as well. So when we help clients to implement equity schemes, we collaborate with lawyers, administrators to help roll out those schemes in Singapore. So before we proceed, we have one question for you today. Okay, what is the main reason you have joined this webinar? Is it first, one, trying to understand how your equity is taxed? Two, are you trying to understand how to report details of your equity scheme? Or are you actually looking out to implement a share scheme? Or you're here for other reasons? Okay, so please let us have your response so that we have a sense of why you're here today. So we probably wait for about 10 seconds. So Tony, once we have the responses in, you can feel free to flash them. Okay, so 41% of the audience here today is just here today to understand how equity scheme will be taxed in Singapore. We have a small number here who is looking to implement a scheme, and some others are here for other reasons. So thank you for your responses. Regardless of the reasons why you're here for today, we hope by the end of this webinar, you have a good understanding of how equity schemes are being treated in Singapore. So on our agenda today, we will touch on the different types of equity schemes, or what we call long-term incentive schemes. Okay, we discuss what is employee stock option plan, ESOP, and what is employee share ownership scheme, ESOW. We will also cover 2 case studies, all right, and discuss key implications of those cases. And to help enforce the understanding, we'll try to have a short quiz during this webinar. Nothing too complicated, just 3 questions, true or false answers. And lastly, all right, although the focus today is mainly on the employee compliance perspective, or what you look out for from employer-employee point of view, okay, we thought it'd be useful to actually highlight some key accounting considerations, and of course, any other tax considerations that companies need to think about or consider when it comes to ESOP. Okay, now I hand over to Adrian to talk about the different types of equity schemes that we commonly see. Adrian?
Yeah, so if we take a step back, ESOPs and equities usually forms part of a wider long-term incentive plans, LTIPs. And on the screen there, you've got a whole host of different types of LTIPs that we come across. You've got all the way from ESOPs and employee stock option plans, restricted stocks, restricted stock units, and employee share purchase plans are the main types of equity-based plans that we see. We do see some non-equity-based plans. So, you know, cash bonuses, as an example, share appreciation rights is another example, and phantom share plans are others. And there's a whole host of things in between. So that's why I said at the outset, it's worth just understanding what you have. Just because it's called a share option plan, or just because it's called a restricted stock, doesn't actually mean it's a stock option plan. So one of the ones that we're looking at the moment is a digital share option plan, which is effectively on the blockchain. But because it's not equity, it's not technically a share option plan in a typical sense of a share option plan. So we're working through how the tax implications of that are. So as I said, always worth understanding what plan you're talking about. The next couple of slides I'm going to go through really goes through the typical vanilla life cycle of a stock option plan and an ESOW. So when IRAS looks at these plans, they typically divide up into an ESOP, employee stock option plan, and an ESOW, an employee share ownership plan. And a normal vanilla plan would usually have 4 triggers or 4 points in the life cycle for an option plan, as shown on the screen there. So on day 1, usually an employer would grant stock options to an employee. Typically, there might be a vesting period for these shares. So there's a vesting period. And during that vesting period, there's usually restrictions attached to the options, such as you cannot exercise the option to acquire the underlying shares. And then once the stock option has vested, then this might be the stage where an employee can exercise the option. And they typically exercise the option by, you know, providing written confirmation that they want to exercise the option, and also paying any relevant option price or exercise price in order to exercise the option and acquire the underlying share. Then obviously the individual has a share in the company, and the next part of the life cycle could be to sell that share at some point in the future. And in Singapore, the typical tax points or typical considerations when you need to consider tax is at the exercise date, when usually the income tax point arises, and that would generally be on the fair market value of the share at the date of exercise, less any amounts paid to acquire that share. So generally the exercise price of the option. And then at sale, obviously when you buy and sell assets in Singapore, there is no capital gains tax. So as long as it's a capital gains, which it generally is when it comes to ESOPs, then it'll be treated as capital gain and not subject to tax in the UK, in Singapore, sorry. So that's a typical life cycle of an ESOP. And the dates that we've mentioned there, the grant, the vest, the exercise, and the sale date, they can be on the same day. So some employees may exercise and immediately sell the shares or part of the shares as soon as it vests. But again, it doesn't detract. The income tax point is still generally at the exercise point. And as I said, the sales doesn't really matter in most cases in Singapore. So if we look at the next one, which is an employee share ownership plan, this is slightly different because we're not talking about options. So restricted shares are usually fall into this category, and some types of restricted stock units fall into this category. So in those cases, the employee doesn't exercise anything. They're effectively granted the share upfront, and effectively there are restrictions on those shares, usually to do with sales. So during the vesting period, they cannot sell the share, and then at the vest date, they can start to sell the share if they wish to do so. And then obviously they ultimately sell the share at some point in the future. Again, from a Singapore perspective, the tax point is typically the vest date when the sales restrictions lift. And again, at sale, there might be a capital gains, but in Singapore, as most people know, there is actually no capital gains in Singapore. So this goes through the typical life cycle of the ESOW and ESOP. And companies usually use these to remunerate their employees for a number of reasons. And I guess as a result of the pandemic, some of our clients have been looking at these in a bit more interest recently, partly because one, there might be tight cash flow, and therefore ESOPs or ESOWs is a way to remunerate employees without necessarily paying them any cash upfront. And secondly, it's a way that you can potentially lock in key employees or lock in employees through the vesting period, because ultimately, if you grant something today, the employee can't actually realize any value until it vests. And most of the time, it'll be written into the option plan or written into the restricted share that if the employee leaves the company during the vesting period, they may forfeit all or some of their options or some or all of their restricted shares. So we've certainly seen an increase in interest in terms of implementing some of these plans at this current juncture. And attached to that, there are a number of industries, unfortunately, where the share price has fallen. And so sometimes when you grant those options, then the valuations are quite low and quite attractive to do that. So as I said, this is a typical life cycle. I'll hand over back to Ruiyuan, who will go through another point where options may be taxed for typically non-Singaporeans.
All right, thank you, Adrian. So what Adrian has covered in the earlier slides is the typical timeline for employees with who are having continuous employment in Singapore. So things do get a little bit complicated when it comes to non-Singaporean employees with equity compensation. So some of you may be aware, in Singapore, we have a tax clearance requirement when a non-Singapore citizen ceases employment in Singapore. Along with this requirement, there's actually a special rule called the deemed exercise rule. So what this deemed exercise rule does is IRAS will deem such non-Singapore citizen employees who are living in Singapore or ceasing employment in Singapore. And if they have unexercised stock options, unvested share awards, they will be deemed to have been exercised and or vested as at 1 month before the date of cessation of employment. So to put it simply, there will be a dry tax charge on unrealized gains. So as Adrian has explained earlier, for ESOP, the income tax point is generally at the date of exercise. So, but when it comes to deemed exercise, this income tax point will actually be brought forward. And this will be regardless of whether the options have vested or not. Okay, as you can see from the two timelines on this slide. So regardless of whether the vesting period has lapsed, okay, when it comes to deemed exercise rule, it will supersede the actual exercise. So if you follow on the timeline, on actual exercise, there could be a potential of to get the gains reassessed. And that is something I will cover on in the later part of this webinar. And on actual sale, as explained earlier, these gains are capital in nature and therefore no tax in Singapore. Moving on to ESOW. So the income tax point is generally at the date of vesting. So under DIM exercise, this tax point is brought forward to the point to the date of DIM exercise. And on actual vest, there could be a reassessment of gains. And similarly, when it comes to the actual sale of shares subsequent to the vesting or DIM vesting, any gains derived thereafter, it's capital in nature and therefore no tax in Singapore. So what happens after DIM exercise rule is applied? A few things can happen, all right? Share price goes down, share price goes up, or some of the shares gets forfeited. So from a Singapore perspective, after DIM exercise rule, if the actual gains are lower, all right, as a result of share price dropping or forfeiture of shares, individuals can request for a reassessment of gains and seek a tax refund. So one key thing that, one key point that we need to note is the request for reassessment must take place within 4 years following the year of assessment, which the DIM exercise rule is applied. So Adrian raised an interesting point earlier is because of this pandemic, share prices have been quite unstable, and in fact, a lot of them have dropped quite significantly over the past few months. So if you happen to have a lot of expats who have left your organization, left Singapore in the past 2 to 3 years, it may be worthwhile to relook at their assessment, because when DIM exercise rule was applied, when they departed Singapore 2 to 3 years ago, share price could be at the all-time high. And given that if the actual vesting is taking place this year or the actual exercise taking place this year, you may want to relook at them to see if there's any chance you could seek a tax refund, especially so if your expats or your employees are tax equalized, and when DIM exercise rule was applied, the organization actually paid the tax upfront in the first instance. So something for you guys to think about. And one of the other thing that could happen is if the gains are higher as a result of share price rocketing, then a lot of our clients are very pleased to know that if that happens, there's actually no requirement for further reporting in Singapore. Okay, so this is typically what can happen after the DIM exercise rule is applied. So now that you have some understanding of the treatment of equity in general, we'd like to go through 2 case studies, like I mentioned earlier, to just run through some of the key implications that you need to consider from an employee and employer perspective. So case study 1, hello Singapore. Adrian has just arrived from the UK. Because he's a senior employee, he has received stock options and RSU as part of his remuneration package. And the company has been doing really well for the past few years. Singapore is his first international assignment, so he has no tax knowledge outside of the UK. And one thing is, he continues to be paid in the UK, and he doesn't think that he should be taxed in the UK, given that everything else remains in the UK. He shouldn't be taxed in Singapore, given that everything to do with his remuneration is dealt with in the UK. So what Adrian needs to know.
Yeah, so what do I need to know? I guess this is me. Unfortunately, I don't actually have options, but never mind. I think the first thing to understand, which we haven't covered so far, is obviously everyone knows that Singapore, or hopefully everyone knows that Singapore generally taxes people on a territorial basis, especially when it comes to employees. There are some exceptions, but not that relevant for the purpose of this webinar. And obviously, then the first question is there options, or is RSU Singapore source or not? Or how do you source those options? Generally speaking, we look at the grant date of the options to determine the source of the options itself. So where stock options are granted when I'm exercising a non-Singapore assignment, so before my Singapore employment or assignment starts, then they will generally be not Singapore source and therefore not taxed in Singapore, even though I'm in Singapore when it vests and when I exercise those options, which is good news. So there's the next point in that, I guess, is obviously sale of shares. as they're employment related, they should still be capital in nature and therefore not subject to tax in Singapore. The final bit to be aware is obviously there's more than one country involved, and the UK being where I was when I first were granted the shares, and I was working during a period of the grant to vest, then the UK would seek to tax a portion of those shares, or when I exercise and potentially when I sell those shares, depending on the rules in the UK. So you always need to look at both sides of the picture. The other piece of this is actually to do with restricted stock units. We haven't talked about restricted stock units much so far, just to say that they are, potentially ESOWs or ESOPs. But with RSUs, it is worth understanding what the plan actually says. We've come across a number of RSUs which at vest does not actually pay any equity, it just pays cash. And if it pays cash, then everything that we said in this webinar so far does not apply because it's not an equity-based plan, so to speak. So RSUs would follow the left-hand side of this column if they're equity-based, but if they're cash-based and I receive that cash when I'm in Singapore, then a portion of that RSU would actually be taxed in Singapore. So as I said, with the stock options, the source of it generally relates to where I am when they're granted, or what employment I'm exercising when they're granted. So if they're granted to me whilst I'm exercising Singapore employment or Singapore assignment, they're Singapore sourced. The share options are taxed at exercise, as we saw previously, because that's when I acquire the underlying shares which I can sell. And the ESOW, so the RSUs, if they are share-based, they would be taxed at vesting, because that's when I acquire the shares again, where I don't have to, where I can sell them. And finally, the same point about capital gains. There's no capital gains on the sale of the shares. And that gain that's subject to tax in Singapore would be the fair market value of the share at the tax point. So that exercise point for ESOPs or the vest point for ESOWs, less any price that I've physically paid for those shares.
So so that would be what the employee will need to know when it comes to equity-based compensation. So from the employer perspective, there's a number of things that employees need to take note of. Okay, so because Adrian's payroll is outside of Singapore, what the company needs to do is, when it comes to employment income reporting, the first thing that the HR would probably need to do, or the payroll team needs to do, is to make sure you reach out to your headquarters to retrieve or request for complete remuneration details in respect of your expat employees. And if there's equity compensation, you need to ensure that the grant dates, the exercise vest dates are all provided to avoid incorrect reporting. Because what we have seen with some of our clients is when they have expats in Singapore and they receive gains from RSU vesting or stock option exercise, they report it through to the Singapore Tax Authority because those were received for us in Singapore. All right, they disregarded the grant date, which would be critical in determining whether they should be reportable in Singapore. And lastly, you need to make sure that employees need to make sure that they prepare and file the IR8A and the relevant appendixes by the statutory due dates. So two key things to remember is equity gains are reported on Appendix 8B of the Form IR8A, and if your organization has six or more employees in the year 2020, you will have to submit your employees' remuneration details via the auto inclusion scheme. Moving on to case study 2. So after a few years in Singapore, the company decided that, hey, it's time for Adrian to move on to another location to help open up markets. So they decide to second Adrian to Australia. One of the incentives for this move is the company will grant him 1,000 units of RSU when he signs the agreement to move. Same thing, the company is still doing very well and share price is expected to keep rocketing. So what Adrian needs to know.
Yeah, so for this example, we'll make a few assumptions. The first one is that RSU is an equity-based plan, so it falls in the equity rules. And I did see a couple of questions come in, so I'll answer that as part of this example as well. So the deemed exercise rule will come into effect as a result of the tax clearance rules. So if I am a PR or an employment pass holder or any other work pass holder, and I'm leaving Singapore employment, which I am because I'm going on secondment to Australia, then the company has a departure tax requirement, so tax clearance. And as part of that tax clearance, which Ruiyuan will go over in more detail, there is a couple of obligations. One is to withhold any money that's due to me, so salary, allowances, expenses. And the second one is to file tax clearance. And as part of tax clearance, I'm deemed to have exercised or all my share was vested to me, i.e. the taxable event arises 1 month before the date of my departure. There are some other dates that can apply, but generally it's 1 month before departure. So as we saw earlier, that brings forward the tax points, but obviously the option plan or the RSU in this case, I still can't access the underlying shares and I can't sell those shares. So I'm effectively paying tax on something that I've not received and I may never actually receive. So we've had cases where the tax due on these unvested, unexercised share awards, stock options, have exceeded the salary of the individuals. So it's worth employers being aware of this situation, especially for your expats, and having a plan in place to deal with it. Whether it's, loaning the cash to the employee, whether it's, forfeiting options when someone leaves the country, just having an awareness of it and a plan is the most important part. So I guess the next question is what happens when I'm in Australia? As we said, the share price is going to continue to rocket up. If this is the case, when I ultimately receive the shares from the RSU, I'm expecting the price to have gone up in price. And under this scenario, there should be no further issues in Singapore. I don't have to report the additional gains that I receive. However, if things don't go well and the share price tanks and falls, then if the share price when I ultimately have the RSUs vesting is lower than the deemed exercise when I left the country, then I can potentially go back and reassess the deemed gains and get a refund effectively. So that's what happens there. And as I said in the first example, it's always worth considering the other side of this. I'll be in Australia in this example, and Australia will probably tax my RSUs. So there's a potential double taxation there, and it's worth understanding from an Australian point of view what the tax implications are. In some countries, they may just tax a portion of the gains that relates to Australia, therefore avoiding double taxation. In other countries, they may provide a foreign tax credit for Singapore taxes. And in other cases, you may even be able to claim a foreign tax credit back in Singapore for overseas taxes paid, depending on which country combination that we're talking about. So worth obviously bearing that in mind where you have expats overseas. The last point before I hand back to Ruiyuan on this is, there is one other way that this can all be dealt with, but we haven't covered in this webinar because we rarely see it, is that if a company applies for tracking options, then effectively you don't have to worry about the deemed exercise rule and you just basically track the options until the date of exercise, as if the expat like myself has not left the country. But as I said, we don't really see this that often. It's very onerous and it is subject to IRAS acceptance, and you need to show you've got systems in place and you need to be very good at that before IRAS will accept you onto that scheme. So that is actually another option that's available to you. Sorry, back to you, Ruiyuan.
All right, thanks, Adrian. So from the employer perspective, what do you need to do? So in addition to having complete remuneration details, okay, I think what is key is to make sure that when you have senior employees leaving the company or moving on to a different location, it'll be important to communicate the withholding of monies to your expat employees. Okay, like the reason explained earlier by Adrian is potentially for senior employees, they could have a huge chunk of options or shares that they have received from the company while they were working in Singapore. And when there's a dry tax charge, potentially the tax arising from de-emphasized could far exceed their monthly income on it, something like this. So what some of the organization is to, I mean, in practice, by IRS regulation, you have to start withholding money the moment you're aware of your employees leaving. In practice, some companies withhold 1 or 2, typically most companies withhold typically 1 to 2 months, and that should be sufficient. But for your more senior employees, that 1 or 2 months may not be sufficient to cover the tax arising from the deemed exercise gains. So this is something that HR team should be cautious of when you are aware of when you're aware of senior employees moving to other locations. So statutory requirement is to make sure that employees file the IR21 and all the relevant appendixes at least 1 month before the date of cessation. And lastly is with the monies withheld from your employees, all right, the company needs to settle the tax directive on a timely manner to avoid any late payment penalties. So remember, for employer, you need to withhold monies for tax clearance. Equity gains are reported on the Appendix 2 to the Form IR21, and the due date to file IR21 is at least 1 month before the date of cessation. So IRS can penalize employees who file the IR21 less than a month from the cessation date. Okay, but of course, if there are valid reasons, IRS is quite reasonable. They will try to understand, okay, what's the reason behind the late filing of the IR21. Okay, so now having gone through case studies, as promised, we'll have a short quiz now, true or false questions. Yeah, so let's start. Question 1. One of my employees is joining another company. I don't need to apply deemed exercise rule on the unexercised ESOP unvested ESOW. Okay, true or false? Okay, so you should see the poll question appearing. So yeah, please select your options. Tony,
Let's see the answers.
Yeah.
This is probably quite a harsh question because we should have given you another option to answer like a tax professional and say it depends, because the answer is actually it depends. So I guess the fact that 50-50 pretty much is answered both ways kind of suggests that you kind of were a bit unsure about it. But yeah, it does depend. Firstly, deemed excise rule only applies to non-Singapore citizens who are leaving the Singapore employment. So in this example, if the employee was a Singapore citizen, deemed excise does not apply. Whereas if they are a PR, an employment pass holder, an S pass holder, for example, and they were allowed to keep the option after departure of the employment, which is generally one, doesn't usually happen, but it does in some cases, then yes, in that case, the deemed excise rule will apply.
Okay, so thanks, Adrian. So next question. So next question is actually quite a common one. So Tony, can you flash the question? So next question is actually quite a common one that we get asked from time to time as well. So either from the employer side or from the employee side. So I have an employee, Singapore citizen, posted overseas. And whilst he's overseas, he exercised the stock options granted to him while he was in Singapore. So the host country has taxed him on the gains. So there is no requirement to report the gains from ESOP in Singapore. True or false?
Perfect. So correct. When your Singapore citizen is posted, well, actually not correct. When your Singapore citizen is posted overseas, they are not subject to tax clearance. And so you don't report a deemed exercise at that point. However, they're still taxed on the share option because the share option is Singapore source on the basis that it was granted whilst they were exercising Singapore employment. And therefore, once they exercise the share option, even if they're in Timbuktu or another country, the Singapore employer has an obligation to report the income gain on the exercise of that option. The company may also have to report that in the overseas country as well, and there may be some double taxation considerations, but there is a Singapore filing obligation in this case.
All right, thanks, Adrian. So the last question that we have is gains from the exercise of stock option vesting of share awards granted in Singapore. They are subject to CPF if my employees are Singapore citizens or Singapore permanent residents. True or false?
So if we are talking about a ESOW or ESOP, they are equity-based schemes. So the individual receives equity rather than cash at the tax point, whether it's the exercise of an option or a vest of a restricted share or restricted stock units. As they're receiving equity rather than cash, they are not subject to CPF at that time. However, it is worth noting that, you know, we flashed up at the start a lot of different types of LTIPs, long-term incentive plans. Some of those which are not equity-based, so things like phantom shares, things like stock appreciation rights, even some restricted stock units aren't equity-based. If they pay out cash, they'll be treated similar to a bonus when it comes to CPF, and therefore they'll be treated as additional wages and subject to CPF like normal.
All right, so thank you for your participation. So in the last bit, in the last section of this webinar, I'll hand over to Adrian to talk about what are some of the other issues that companies need to be aware of from the accounting perspective and also from the other taxes perspective. Adrian, over to you.
Yeah, so we've obviously talked about the employer obligations and the employee tax position as the main thing, and we thought it would be useful to highlight some of the key accounting considerations and other tax implications as a result of issuing plans, because we generally see employees when they set up a stock option plan, they just ask about how is the employee taxed, and they don't consider these other pieces as well. The first point from an accounting one is to determine the grant date fair value. And I think the first part of this is what is the grant date? From an accounting perspective, the grant date is not necessarily the same date as a tax perspective. And it really looks at when that individual effectively was entitled to be granted that equity plan. So, you know, if you've got an employment letter, for example, welcome to the company, we will grant you 300,000 stock options, but you only get around to granting those stock options 1 year later, the grant date may still be the actual employment date letter rather than the grant date on the option plan. So worth just checking that, because obviously that will have knock-on implications on your accounting when you're accounting for the stock options. The second one is, I've covered this a little bit. When you're looking at equity plans, you need to be wary that some equity plans aren't equity-based. Some of them are maybe cash-based, and so they pay out in cash rather than pay out in shares. And when you've got cash-based payments, you may need to market those every year when you're accounting them. So that's where the second point comes in. The third point is we've talked about vesting periods, and in our examples, we've taken very simple examples where, you know, you're granted an option, it vests in 1 year, 2 year, or whatever period of time. We come across a lot of equity plans where options are granted and a third of them may vest in the first year, a third of them may vest in the second year, a third of them may vest in the third year, rather than all vesting at a cliff, say all of them vesting after 3 years. So you need to know this when you're accounting, because there'll be different accounting points and a different accounting periods to consider. Effectively, when they're graded, when they vest over different periods, you may need to front load some of those expenses. And the last one is, as I said at the very start, I think devil is in the detail. Depending on what the plan says, different conditions, different forfeiture conditions may complicate how you disclose the equity scheme on your financial statements. So it's worth making sure that you understand how your equity plan is run, what the conditions are, so that you can correctly account those on a financial statement point of view. And I guess there's one question about how do you value companies? How do you value private companies when there's no open market value? Sometimes you can just get a valuation. Obviously, if you've had a recent funding round, then that might provide an indication of the valuation, or companies like ourselves can help you value those options or those equities. Or IRS does give you, there is a backstop in IRS which allows you to look at the net asset value of the based on the previous set of accounts. But I'll just warn you on that. If you use that and you've recently done a funding round which suggests a much higher valuation, then obviously IRS may not agree to the NAV in the previous set of accounts. So on the next slide, we've got some other tax considerations. And I wanted to bring up the corporate one first, because it's very different from other countries that I've been based in and I've dealt with. The main thing is that the tax deduction from a corporate perspective does not mirror the employee income tax rules. So as we said, you know, if you exercise a stock option, the gain that's subject to income tax is the fair market value at the date of exercise, less whatever you've paid for it. However, the corporate tax deduction will not mirror that. It's not straightforward. There's lots of ifs and buts and rules. But in summary, if the share option plan is issuing fresh new shares, then broadly speaking, you won't get any tax deductions for the issuance of those shares. If the company is acquiring shares in order to meet its obligation under the stock option plan, then the cost of acquiring those shares may be deductible from a corporate tax perspective, but that will depend on a whole host of other rules as well, which we won't be covering in this slide. So yeah, corporate tax is very different from the employment tax side of things, so something to watch out there. And I guess related to that is the transfer pricing piece of things. So if you've got ESOP costs, and I guess there's two types of costs that we need to consider. One is the cost of setting up, running the scheme. So like your trust fees, your legal fees, those will generally, if they relate to providing employees with a benefit, they can generally be deductible. It's the cost of the share itself, which I'm talking about in the corporate tax side. So when it comes to allocating ESOP costs, if you've got ESOPs which are granted to people in different countries, then you need to consider the transfer pricing rules around those. How much of those costs should be transferred to the Singapore entity or transferred from the Singapore entity to your related companies where the employees are employed? What's the mechanism of that charging? And obviously where you've got expats who were granted it in one country and then exercised it in another country, there are more complicated rules to consider as to whether any costs should be charged or whether a portion of the cost should be charged. So certainly whenever it comes to expats, they're special and just need a little bit more looking after. The final piece is GST. And with GST, it's worth noting that obviously this applies whenever there's a supply of goods or services. And the sale of shares from a company to their employee is a supply for GST purposes. So just worth making sure you get GST advice to make sure you know what the treatment is on those shares and that they are reported on your quarterly or sometimes monthly GST returns. There is a slight difference again when it comes to issuance of shares which are new versus issuing of existing shares. And the main difference here will come to whether you have to do the partial exemptions, which is effectively the final point. Because obviously, if you've got a supply of services which are exempt and they exceed certain thresholds, then you might need to actually apportion your input tax when you recover it. And basically where you have these shares that are being issued, you may be in a better position than if you're acquiring shares and using those to satisfy the option plan. But again, those are complicated rules. They depend on which industry you're in as well, and also a few other pieces of facts. And if you've got any questions on that, then we can certainly assist you with those as well. So with that, I think we've overrun slightly, but on 35 minutes, but we still have some time for some Q&As. So if you've got any questions, feel free to post them on the Q&A section. And I think Casey or Tony will help ask those questions. And Casey and Tony, even if I've answered them already, let's ask the questions and I'll answer them again.
Perfect. So yeah, we've got a few questions. So the first one is, Singaporean PRs, are they considered with Singapore citizens or with foreigners?
Yeah, so neither, I guess. But I think the question relates to the deemed exercise rule. So the deemed exercise rule only kicks in when tax clearance is filed. So if you need to do tax clearance for the Singapore PR, then generally speaking, deemed exercise rule will also kick in. So if your Singapore PR is leaving the country, then certainly deemed exercise rule will be applicable. If your Singapore citizen is leaving the company but going to another company or staying in Singapore and they sign the relevant forms to confirm that to you, then you may be able to avoid the deemed exercise rule in that case, assuming that they can continue to hold the stock options after they've left the employment.
The next question ties in quite nicely to that. What causes / creates a deemed exercise? Some examples would be helpful.
So deemed exercise is really tied to the tax clearance, and the rules for tax clearance are actually quite complicated. At a 40,000 feet, it's basically when a non-Singapore citizen leaves Singapore employment. So generally speaking, we see that when employees go on secondments abroad or when employee leaves the Singapore employment. But it's not just those cases, and sometimes, you know, someone might go over for a 3-month training course overseas. There are some exceptions for certain travels overseas. So whenever you have a non-Singapore citizen leaving the country for any period of time, it's worth just checking the rules to see whether they're caught by tax clearance and therefore caught by the deemed exercise rule.
Thank you. So for private companies where open market value is not available, would IRAS look at the net asset value per the latest available audited accounts instead?
Yeah, in default they would, as I think I said earlier. So if you've got a private company where open market value is not accessible, IRAS would default to the net asset value in the previous set of accounts. But, you know, as I said, if you're fundraising, for example, and it shows a different valuation, because fundraising isn't generally on net asset value, it may be on, you know, multiple of earnings, multiple revenue, whatever it is, depending on industry, then IRAS may not accept the net asset value, which would be a much lower value in that situation.
When you refer to gain, are you referring to the value derived upon sale or the value gained at exercise, i.e. MV less paid?
Yeah, so whenever we refer to gain, there's two gains that can arise. One is an income gain and one is a capital gain. The income gain would arise at the tax point, which was either the exercise of an ESOP or the vest of an ESOW. The subsequent gain when the individual sells the underlying share would be a capital gain in most cases and therefore exempt. So the income gain is usually fair market value at the tax point, less any price that's paid to acquire that share. So something that we didn't cover is sometimes clients would issue just ordinary shares to their employees on day one for nil cost or for a reduced cost. Same rules apply there. Since there's no sales forfeiture, they're taxed on day one. And the tax point is the fair market value at day one when they're granted them, less anything they're physically paid for those shares.
How would the IRS find out if we did not report the gains from equity schemes?
You want me to take that?
Sure.
Okay, so that's actually a good question. There's a few ways that IRS can actually find out. So when I was with my previous firm, one of the big four, sometimes it's through your employees. Okay, I can explain how that happened. So sometimes you have innocent employees who, when they are filing their income tax return online, they know that, hey, they heard from somewhere that gains from equity compensation are taxable. My employer hasn't reported that. So they will key into the tax return, and that would trigger IRS to question the company, because remember, any organization who is in AIS under the auto inclusion scheme, they will have to transmit those information directly to the IRS. So that's one way IRS could find out. So on the flip side, if sometimes it's not an innocent employee who is making that call to the IRS, it can be a disgruntled employee. Okay, for some reason he's been dismissed from the company. He knows that the company is not correct in reporting, especially from the equity side of the house. They just talk to the IRS, and that kind of trigger IRS knowing that the company hasn't been compliant when it comes to equity reporting. Another way that the IRS could do is actually, they could even do it through the corporate tax return, and I can explain that. So we talk about corporate tax deduction in one of the slides. So if in the corporate tax returns, the company is claiming for expenses on ESOP, and when they look at the employment income tax details being transmitted, there's no hint of any gains from equity, that will trigger IRS to ask question as well, whether or not the company has is aware of the requirement to file equity gains for their employees. So in the past, one common way of IRS finding that out is they start, a few years back, they started issuing tax questionnaires or just survey forms to companies, okay, asking them, hey, do you know that this item is taxable? So have you reported them in your employee tax returns, as in the form IRA, IR21? Then the company just respond accordingly. And when they tally it against the records, okay, they realize that you say you know that it's reportable for tax. They haven't seen it being reported before. They start to ask questions and start to dive into your records. So these are the few ways that IRS can actually find out that the company is not being compliant. So, yeah. So anything else to add from Adrian? Yeah.
This is a follow-up to one of the questions I asked earlier. Can you clarify the income tax point on vesting of ESOP? Do SG citizens have to make tax payments?
Yeah, so if we take a step back, ESOPs and ESOWs are two different things. So with ESOPs, the share option plan, the income tax point is actually on the exercise of the option in most cases, rather than the vest of the option. Whereas an ESOW, because there's no exercise per se, at the vest point, that's when the tax point comes. So if you take a step back, generally a tax point is when the individual has a share that they can physically sell. When they can sell that share, that's generally when the tax point is. And that's why from an ESOP perspective, at vest, they don't have a share, they've only got an option. And that's why, you know, it's the exercise date when they acquire the shares that is the general tax point. From a Singapore citizen point of view, yeah, they have to pay tax when the income tax point arises. So once an income tax point arises, the employer would report the income gain on the IRA Appendix 8B, and then the individual have to pay tax with the tax return as per normal.
What would you say is the key advantage of issuing phantom share option plans from a GMS perspective?
I would take a step back on that question. I think whenever someone is implementing a plan, there are advantages and disadvantages of issuing phantom options or phantom shares over actual shares and actual plans. And some of them may not be tax related. It may just be simpler administratively to do a phantom plan, because you don't necessarily have to play around with the articles of association. You don't have to create a new class of shares or create additional shares or purchase shares to satisfy the option plan. But from a GMS perspective, it depends on the countries as well, because every country will obviously have its own tax rules for options, and every country may treat phantom options differently, because most countries, the legislation for options is around equity and shares. And obviously phantom, there is no shares because it's phantom, you make it up. So I wouldn't say there was necessarily key advantages. In Singapore, I guess, because it's not an equity plan, it is not subject to the deemed exercise rule. So I have had clients who specifically don't want to be caught by the deemed exercise rule because of that cash flow issue when an individual leaves the country and has to pay tax on equity that they've not been able to sell. And a phantom plan, or like a bonus, for instance, is another plan which is cash based. They won't pay tax at that date. They'll only pay tax when they receive the cash. But obviously the disadvantages of that is they have to report it after the individual's left, so you need to track it. And also the price of that option plan or the amount may have gone up, whereas a deemed exercise rule will fix the price effectively or cap the price at the price when the individual leaves the country.
Thank you. I think we've got time for a couple more questions. What about shares that employees buy in their own accounts? Do we need to report these, and are these taxable?
Ryan, do you want to take that one?
Yep, I can take that on. So I think this is in relation to employees buying shares from the company from their own account, right? So remember what we talk about here in this webinar is employment-related equity compensation. So that would be things that are granted from the company as part of the employee's remuneration package. So when it comes to personal investment, okay, unless this employee or this individual is trading shares, okay, anything that he invests from his own account will be capital in nature. So he can buy and sell shares of the company he's working for. Okay, those gains would be regarded as capital in nature, no tax reporting requirement in Singapore.
And Ruiyuan, how do these rules apply to consultants who may enjoy a right to acquire shares?
That's an interesting question. I think over the course of the last 6 months, we have been asked this question a number of times. So consultants, that is a tricky area. They are not essentially employees of the company. So, but if we're talking about payments, okay, in the form of shares for services rendered by the consultants, then that could be a different area we need to look at. So I wouldn't say it's that straightforward. We probably need to take a look at what's the arrangement between the consultants and the company. Are they truly consultants, or do they have any employee-employer relationship to determine how do we want to report that income?
Yeah, so just to add on that, I think taking a step back, I completely agree with Ruiyuan. The first thing is you need to understand, are those individuals actually consultants? Because when you deal with a relationship between an entity and an individual, they can either be an employee or a consultant. They're the two main forms. And the fact that they have shares is an indication that they're actually an employee rather than consultant. But obviously, has to do with anything in tax, the facts and circumstances will actually dictate the actual relationship. So you'd probably need to understand that a bit more before you delved into the tax position.
Thank you. So not a straightforward one.
Yeah.
Are there any, I'll just do this one and one more, to anyone who has submitted questions, just in case we don't have time to cover them, if you could send your name into the chat box, if you submitted them anonymously, and then if we don't have time to answer them, Ruiyuan and Adrian will contact you separately after the webinar. So I'll just do two more. Are there any tax efficient ESOPs?
Yes, but not in Singapore. So in other countries, there are tax efficient equity plans. In Singapore, there used to be efficient plans, but not anymore. And generally what we mean by efficient plans is it effectively moves the income point to a capital gains point. So in Singapore, that would be changing the income tax position to capital gains, and obviously there's no capital gains, so therefore there's no tax at all. But unfortunately, the government removed those incentives or those efficient plans a little while ago.
Okay, last one. What happens in a merger and what happens if there is a merger and my old share options are cancelled and new ones are issued?
Seek advice. It depends on the facts again of the case. So if options are actually cancelled and you receive nothing for them, then probably nothing happens. But if you receive something of value for those options, then there may be a tax consideration there. So a lot of time with mergers, either options just get replaced, or sometimes options get accelerated, and therefore the individual does receive some payout in the form of shares or cash, and there could be a tax implication of that merger. So it's worth just understanding what that is, especially where you have expats who've travelled across different countries.
Perfect. Thank you, Adrian and Ruiyuan. As I said, if you have submitted a question that we haven't had a chance to get through, please just drop us a message in the chat, and Ruiyuan and Adrian can contact you after the webinar.
And thanks for staying till the end.
Thank you very much for joining us. The recording and slides will be available on our website later on today. Thank you, everyone.